Hello, and welcome back to another episode of Not Fintech Investment Advice. This is the podcast where I, Alex Johnson, get together with my friend and the author of Fintech Brain Food, Simon Taylor. And as the name of the podcast suggests, we don't give advice about fintech companies. We examine fintech companies, we get excited about fintech companies, we geek out about 4 fintech companies, but we don't give advice on them. And that is actually really important because this is a overly speculative episode of Not Fintech Investment Advice. Simon and I hit some of the same themes we always talk about. We get into agentic commerce and the shift from card on file to human on file. We talk a little bit about mortgages for real estate investors. We talk about vertical specific small business credit card lending. But we also talk a little bit about a mysterious stablecoin company that honestly no one really knows anything about. But we couldn't help speculating a little bit on what that company might do and what opportunities they might have, especially given the rumored valuation that they are raising at. So, lots of fun content in this episode. As per usual, we also end with a plea for the ecosystem on a thing that Simon and I want to see built. This thing relates actually to a passion of mine, which is how do we help consumers from falling into financial despair due to gambling. So if you're looking for something new to build, we talk a little bit about that at the end. And before I let you listen to this episode, speaking of looking for inspiration on things to build, I am very proud to announce the first ever in-person FinTech Takes event, which is coming up this fall. It's the second week in November, and we are calling it the FinTech Takes Builders Summit. This is going to be a very small, off the record, invitation only event for experienced operators and builders in fintech, folks who are just about to start building a new company or a new product in financial services and are maybe looking for a little help, a little inspiration, maybe looking to glom onto a problem or an idea that they can get really passionate about. This might be the event for you. So while it is invitation only, I do want to mention it because we're going to drop a link in the show notes to a waitlist that you can sign up to get more information. And if this is something that sounds interesting to you, either to attend or potentially to sponsor, please add yourself to that waitlist or send me an email. And we will be releasing more information about the FinTech Takes Builders Summit coming up in November of this year in the mountains outside of Bozeman, Montana. Very exciting. Now, without further ado, I'm going to drop us into today's episode, Not Fintech Investment Advice with Simon Taylor. Okay, well, Simon Taylor is here. Mr. Taylor, it is great to see your face. Unfortunately, we did not get to see each other in person at StableCon, even though we were both there. We were, I think, running around with our hair on fire. You in particular, I like to think of you as the mayor of Stablecoin Town, the public announcer. I'm not sure what I would sort of classify your job in this village at, but you're very much at the center of it. How was your New York stablecoin experience?
Shout out to Nick Milanovic. This Week in Fintech, StableCon is the event that you cannot miss if you care about stablecoins. Holy heck, the timing was perfect. It was actually Stablecoin Week in New York. So I had a great week because I was with, CFOs of Fortune 500 companies, heads of payments from, some of the top 5 banks, all of whom are trying to figure out stablecoins and figure out how seriously should I take this? What should my strategy be? We like to say on the Tokenized podcast, every company needs a stablecoin strategy. Well, it seems like every company is trying to build it. And this all just happened at the same time as that conference. So, it was great from my perspective. We got to host a dinner for the Tokenized podcast and just saw some incredible people. But like you said, I think the nature of doing what you and I do now is just wherever we are, there's somewhere we're not, and we can see it. It's over there. And we don't get to do that thing because we're doing this thing, which is also really cool. And no matter how much the AI scales some of the stuff we do, it's not going to scale that I can't be in 2 places at once. So, but it seems like the conversation for stablecoins is in lots of places at once. You had a fun week.
I did. Yeah, no, I was very grateful to Nick for the invitation. I, unlike you, am an amateur on this topic, though trying to learn and trying to come up to speed. And I had the really fun opportunity, actually, speaking of things that are in the news and hot topics right now, to moderate, to regulate, to moderate a panel on the shifting regulatory sands of stablecoins. And so I had. It was great. I had lawyers on the panel. I had former regulators, including Yelena McWilliams, who was the chairman of the FDIC once upon a time. And so really great group. And, it's kind of funny, like if you want a really spicy panel, get a bunch of financial services lawyers who've been frustrated in their attempts to push forward innovation for a sustained period of time, and they can't wait to just let loose. And so I almost got to the point where I just sort of let the panel do its thing. And at one point, partially because we had some sort of audio sound issues, Yelena just took over moderating the panel and just started doing my job for me, which is kind of the dream as a moderator in a lot of ways. And so it was a lot of fun. Got to have a lot of good conversations with folks about stablecoins and other sort of fintech adjacent topics, as I always do when I go to New York. So yeah, tons of fun, very productive. A little bit tired, but excited, Simon, as always, to bandy about some fintech companies as a part of Not Fintech Investment Advice. I know you have a couple picked out. Why don't you go first, Mr. Taylor?
All right. I was hoping that you'd play my special request, Mr. DJ, that because I put one in this week. I was like, please cover this one for me because I know nothing about this part of the universe and I want to learn. But we'll come to that second. I think we'll find out what that is very, very soon. So the first one is Nekuda, which makes me want to say "ooh, barracuda" every time I hear it. Which like is a song from before you or I's time, but yet still the earworm persists. That is what it is. So Nekuda safely stores and protects payment credentials that AI agents can inject at checkout for human not present transactions. The Nekuda SDK collects user mandates and securely manages those payment credentials, sharing them with merchants, processors, and card networks. So I called Nekuda making AI agents checkout ready. It's like everything I need to wrap around an agent to get them ready for that checkout. So I sort of saw this, and they just came out of stealth. They're a relatively early company. But I immediately thought that human not present has a really, really nice ring to it, doesn't it?
It does.
Certainly if you've got a payments ear. Like if you're brand new to it, you're like, no, it just sounds like a person's not there. But card not present is what we called online e-commerce transactions in the early days of like e-commerce really taking off. Why? Because there's no point of sale at which a card is being swiped. Like that's not happening anymore. So that physical security had gone away. You were just typing in the details. And that led to a whole range of fraud because you can type in the details even if the card's like hundreds of miles away from where you're using the laptop. Now, human not present potentially opens up a bunch of new fraud risks and challenges and all kinds of stuff like that. So I imagine fraud teams will instantly like shudder with that. But then the way we got around a lot of that was merchants started doing this idea of card on file. So I'm going to collect you. I'm going to sign you up as a user. I'm going to store your card. So it's super easy to check out. But also I know who you are. And that's kind of how like Shop Pay and the accelerated checkouts work. They store your card on a file and they use this idea of tokenization to do that. Right? I know not are looking at doing something similar. But this SDK is kind of coming on the heels of Visa's intelligent commerce, which is giving tokens to agents. So card on file becomes agent on file, but the agent isn't on file necessarily at the merchant, just the merchant. They might be on file at the merchant, but with the processor, with the network, with the LLM that you're using. So Nekuda seems to be trying to build for where Visa, for where MasterCard are headed to with this tokenization wave that's kind of coming. So agentic commerce. You say that out loud, and VCs just kind of try and throw money at the words. It's crazy out there in the agentic commerce world. But what say you, Alex Johnson? Are you catching that, or are you still in the not fintech investment advice bucket?
That's a great question. I've thought a lot about it because Simon, as you and I joke on this show from time to time, at some point we'll just identify like the hottest VC trend, and we'll just quit our jobs and go found a fintech company just to like rake in all that cash. And so I always try to keep my eye on like what's the one that's going to cause Simon and I to like give up the jobs and just go found a company and just collect massive VC checks. Agentic commerce is quite close, right? I would say. I mean, it's an incredibly hot topic, and I think not only from a VC perspective, but as you outlined, like Visa, PayPal, Google, Amazon, like everyone is taking agentic commerce very, very seriously. I love the framing of this as card not present to human not present, card on file to agent on file. Like this progression makes sense, right? And I was talking to someone from one of the card networks, and they were sort of giving me a rundown on how they're thinking about agentic commerce. And they described it the same way, where they're like, look, we've already done this evolutionary leap forward multiple times. And so we kind of know what to expect, right? Because we saw the jump from in-person commerce to e-commerce, and the jump from e-commerce to mobile commerce. And it always kind of plays itself out roughly the same way. So we know what problems to expect. We know what problems to try to solve for. And to your point, it does seem like Nekuda is very much aiming at, like, we want to be an enablement layer for the problems that are going to have to be solved when this inevitably takes off. So I think that's all absolutely true. I am fascinated by this idea, and I know the card networks and Nekuda and others are very focused on this, but this idea that, like, in a way, strangely, this is like a reversal of everything we've been working on for the last like 5 to 10 years. Like, it's all been about keeping bots out of commerce. And now the challenge is, like, how do we let the right bots in, and under what parameters, right? So I think that, it is a fascinating problem to solve because, if you compare it to, again, like, e-commerce fraud seems so quaint in comparison, right? Like, oh no, someone might have taken my card when I was at a restaurant and skimmed it, and now they're going to use that to go shop online. Like that is so quaint as a problem compared to the problem of someone has spun up 10,000 different agents all using different versions of my credentials, and they're all automatically trying to pretend to be my authenticated agent that is trying to buy a bunch of stuff on my behalf. Like, the scale of the problem and the velocity of the problem with agentic commerce makes kind of classic e-commerce card not present fraud seem very quaint and small by comparison. So I think it will be a really interesting infrastructure test, and again, speaks to the value of the problem Nekuda is aimed at. Like, people are going to invest a lot of money in trying to make this feel safe. I think, Simon, a philosophical question I want to bounce back to you is, and you've been digging into agentic commerce far more deeply than I'm kind of curious to understand where agentic commerce really gains traction with users and what use cases make sense, right? And the things I've been thinking about are things like the distinction between B2B and B2C, for example, right? Because in a B2B context, I could easily see you going, okay, I want to set an agent to the task of making sure I always have the supplies that I need to run my business, and to source those supplies from trusted suppliers at the lowest possible cost, and to do so in a way that makes sure I never run out of what I need, and that I'm always sort of perfectly supplied in order for my business to run smoothly. That makes a lot of sense to me and seems like something that agentic AIs could really help with. By contrast, I am starting to see a lot more discussion around agentic commerce kind of replacing other forms, I guess, of e-commerce. I think you wrote about Google sort of doing some announcements in this space recently. And I guess I'm a little more up in the air on what that's going to look like. And I guess to a certain degree, what the net benefit for end users is going to be. Because, I don't know, sometimes with payments, it's kind of funny. I will feel us like rush into a future that gets merchants really excited because it's a more seamless way for them to sell more of their products. And we sort of forget the customer on the back end of the process, which is, yes, I want a seamless process for conducting commerce, but I also like want to save money. I want to consider my purchases carefully. Like sometimes a lack of friction is actually a problem for customers. And I think that this conversation has cropped up around BNPL and a whole bunch of areas where we've sort of streamlined commerce. I see the flip side of that problem when I look at agentic commerce, particularly from a B2C perspective. What say you about that?
Yeah, it's interesting that like where do I want to insert the friction and how do I insert it now becomes a design choice for the people whose incentive might not be to insert friction. So
that's really well said.
The piece I wrote was called "The Checkout Page is Dead," because the checkout page was where I, as a merchant, did everything in my power to convert you with low friction. But I was also trying to capture enough information about you to figure out if you're a fraudster. So I was constantly, because I was liable for the fraud risk, especially in the United States. So I want to do everything I can to remove friction, but I want to ambiently capture as much data as I can about you to figure out, should I step you up actually? Should I reject this transaction? Like, where do I want to go? And then I'd spend, I think, something like 50% of revenue on trying to attract new customers. And I'd do that with the Googles, with the Metas, with everybody else to try and bring somebody in. But what happens when they are the owners of the checkout page, as it were, or the checkout agent? And there's a couple of interesting problems. Like, how do I know as a merchant that my ad spend is even going in the right place? And if it is, I'm really going to want that to convert, because how am I supposed to know if this is a fraudster or a bad guy? How am I supposed to A/B test any of this stuff? So I take it from the perspective of like the deck chairs have really shifted. And the biggest loser short term is probably going to be the merchants themselves, because they see a lot less data and they have all of the risk and liability in the current model. And so the other side of it, the Googles, the OpenAIs, I think OpenAI is now the 7th most viewed web page on the internet. There's 4.5 billion monthly active users. Like it's just insane how popular this thing has become. Some folks I've seen saying that like up to 10% of their inbound is coming from, like their sales leads are coming from the chatbots now. And then ChatGPT is way and above. And SEO is now becoming AEO. Like I'm kind of advertising for that.
Right,
so why, if I'm selling a subscription and my job is to be useful to you, would I want to insert friction? Maybe it's because my USP is actually the user. I am selling a subscription to the user. I'm not necessarily selling that item. So there's this whole question now about, what do the LLMs share with the merchants to keep the merchants on side? Because there's a real, like, don't sell my data, please, ChatGPT thing going on. But so the whole business model of the internet is now up for questioning, because the last 20 years have been about how much data can I get? How much privacy can I take away from the individual in order to retarget them? Because I have imperfect data about what they purchased, because the card networks and the merchant ecosystem that sits around it just haven't built a model that's ever worked as an ecosystem. Loyalty data does not flow with a transaction. Okay, so we'll just spend a load on advertising and we'll use data as the revenue engine. Now what's it going to be? Because they almost can't sell ads, because if they do, they're breaking the promise to the user. And if I'm being user-centric, I want to make sure you don't get defrauded. So maybe my incentives align with you, maybe they don't, but what can I give to the merchants? So yeah, I after I wrote that piece last week, I had people from some of the AI labs, from some of the biggest commerce websites and some of the biggest payments companies reach out for a chat. And I can tell you that even at the frontier, nobody knows the answers to these things.
Yeah, no, it's exactly right. I mean, there was also a piece kind of timed right around the same time that yours came out. I think it was from Ben Thompson at Stratechery, where he was kind of writing about the same stuff. And he's probably the number one scribe of like internet sort of economics, I would say, over the last 10, 15 years. I mean, he's written a ton about aggregation theory and advertising and e-commerce. And now, of course, he's writing a lot about AI. And he was sort of poking at some of those same questions where it's like, fundamentally this sort of business model question. And you'd like this piece if you haven't read it, Simon, because he actually tied stablecoins in as a form of payment.
I think it was called the original sin of the internet, right?
Yeah. That's right. And it was about how advertising, some have said, is sort of the original sin of the internet, and how when Mark Andreessen and others were building early versions of web browsers, they couldn't build commerce or payments capability directly into the browsers, so they had to be supported by advertising. So there is this sort of like more essential question about how do you essentially align interests between consumers, the platforms that consumers rely on to find information and ultimately shop and find products, and the merchants who sell those products, right? And there's these different layers that sit in between each other. And I think, as you say, the web has been very oriented towards consumers get free access to all the information in the world. They can search for anything, they can find anything, and we will monetize that process and that experience through ads, which have its own sort of set of pros and cons. As you're saying, like AI just scrambles that entire equation in a very interesting way. And it actually does sort of remind me, Simon, a little bit of the sort of thing we've wrestled with in banking for a long time, which is like this question of should checking accounts be free, right? Like, oh, free checking. That's great. But checking is not actually free. It costs money to store your money safely and give you access to it. And by giving you checking for free, we've essentially pushed the monetization down to a different layer that may or may not be that good for users. And so, I find agentic commerce to be such an interesting sort of opening salvo in a larger conversation about how do we align interests with users? How much should we expect users to have to pay for these services versus having their data, or in some cases, like their intention, monetized in other ways? And what are the consequences of that? And I find that to be a pretty interesting debate. As you said, no one really knows the answers right now. But I think, particularly for a financial services audience, like if you're a bank or a fintech company, and part of what you do is payments, but part of what you do is like money management or money storage or wealth management, you need to think very carefully about the overlap of these questions, because we could very much end up with a model that is good for merchants and good for payment facilitation, but not so good for the kind of the long-term financial health of your customers. So I think that's kind of the tension I'm looking at.
I absolutely agree. Nekuda's blog, by the way, is excellent. They go into a lot of this stuff in detail. So that's my pro tip, is like whenever you see an interesting new company, check out their blog, because chances are they're telling their story there. And you can kind of get a lot of insight from doing that sort of thing. So we will come back to this often. I think it's nice to know when you're sort of exploring these topics that there are unanswered questions. And I can't remember the last time we couldn't take for granted that this is how the internet will work. And it feels very Web 1 almost, of like, what's this even going to be? Like, and it's kind of weird and esoteric, and that's kind of fun. That's exciting.
It is. No, I mean, it is very Web 1.0. And to finish off that analogy, from a VC perspective, it feels a little bit like there will be a .com bubble bursting at some point, because I don't think all the money getting shoveled into agentic commerce is going to get paid back. But as we saw with the .com bubble bursting, a lot of value was also created out of the other side of that. So I have a hunch
at least in domain squatting, like that.
Yeah, if nothing else, right?
Hold on to the domain for 20 years, you'll be good.
That's right. Yeah, domains have never lost any value. All right, Simon, you hinted before at this, but you put in a request to the Not Fintech Investment Advice DJ to play a specific song, one that you were hoping to maybe hear for the first time and learn about. You gave me a company and, sort of suggested, hey, this might be one to look at. I took the bait and did a little deep dive. So can I run you through it?
Please do. I am curious.
Okay, well, I appreciate your curiosity. The company is called Votive, Votive. And I guess the easiest way to describe them would be that they are embedded mortgage lending for investment properties, or put even more simply, BNPL for real estate investors.
Yeah.
And that is a gross oversimplification, but I will explain. So These guys were founded, I believe, in 2017. They raised $135 million in 2022. And they just raised some additional equity financing from Citibank, along with a $150 million revolving securitization shelf, which will help provide liquidity and funding for the lending that it's doing. So essentially, what they do is they connect B2C companies, so consumer-facing companies, or I should say, B2B as well, like businesses, real estate investors, but basically like brokerages, proptechs, banks, credit unions, even landlord services marketplaces. Basically, anyone who has sort of access to or potential interest in real estate investment properties. And then on the back end, they connect that with private credit firms as well as other secondary market investors and investment vehicles, enabling those B2C companies to embed mortgages for investment properties directly into their platforms with very little minimal effort or lift, right? So they basically allow for those platforms to make mortgage products focused on real estate investments available to their end customers. Now, there are two products that they offer right now. One are kind of short-term bridge loans for kind of fix and flip properties. So figure like a 6 to 24 month loan, interest only. Hey, I want to buy this old house that was built in 1978, fix it up, make some repairs, and then put it back on the market and flip it. As well as long-term rental properties where the model is more, hey, I want to buy this, rent it out, and then use the cash flows from the property to pay the mortgage. And so those are more of your classic 30-year amortizing loans, or in some cases like a 5 to 10-year fixed loan. And the underwriting for those is based on the rental cash flow rather than the personal debt-to-income ratio of the individual borrower, which is kind of nice, right? So this is essentially what they do. As I hinted at before, they're pretty well established at this point. They've done multiple $1 billion worth of loans. Citi's investment decision and decision to provide funding for securitization, I think, is a pretty good signal that they've sort of reached that institutional acceptance sort of level, which a lot of times with these types of networks is the hardest part, right? Scaling them up, attracting sufficient participation on both the borrower side and on the funding side, just to kind of get the flywheel spinning. They seem to have sort of gotten to that point, which is great. The big thing that I want to flag for you, Simon, that I think is just a really interesting discussion is the underwriting and the origination process, right? Because ultimately, these guys sit in the middle. They don't really hold any of the loans, right? They're securitizing them, they're selling them, they're putting them into warehouse facilities that they've already set up. So they do that on the back end. On the front end, they don't really have any direct relationships with the end borrowers. They're working through distribution partners through that embedded model that I described. So really, the core mechanics of what these guys do is the origination process. And, they claim to have a model that takes in thousands of different data points and can assess all of this and uses machine learning, kind of your typical story. And I'm sure that's all true. And I'm sure their underwriting model is very good. I will say, the older I get, the more that like things I'm seeing rhyme with things I've seen in the past. This does rhyme a little bit with, do you remember the iBuying frenzy that happened a little while back with, real estate platforms like Zillow basically getting into the buying and flipping business directly. And they would make these like cash offers to people who wanted to sell their house directly in the platform. And the model they had was very similar to this, where it's like, hey, we can value this property. We can understand what the value of this property is in the context of the market that it's in. And if we want to buy it and then improve it and then flip it, we should just do that directly and just cut out buyers and mortgages and all of that and just do this directly. Now, that model was a little different because that was Zillow or those other platforms taking that risk directly, right? Because they were the ones buying the platforms and funding them and holding them on their balance sheets while they tried to flip them. The thing that's important, though, is that much like Vontive, these guys also talked about, we have this big underwriting model with all of these data attributes and all this machine learning. And it's really smart and it's great. And again, that was true. But what they found was if you're even a little bit wrong right? If you even just guess, say, for like houses in Sunbelt states, what the valuation of those properties is going to do over the next 9 months, if you're even just a couple of basis points wrong, you can be wrong in a huge way if you're doing this at scale, right? And so they went from having like a profitable but relatively thin margin business to, I think Zillow ended up with like an $800 million hole in their balance sheet caused by iBuying, right? Which is why they got out of it. So again, Votive is a little bit different, but I think the same idea of we're going to centralize and be sort of the centralized point for underwriting. When you're underwriting an asset that has so much like regional variability, you run that risk that that model error can create significant losses very quickly. And so that is the thing that I'm looking at with these guys. The other thing, just more broadly, and this applies to everything in mortgage, is mortgage is a very, very cyclical business, right? And so a lot of times you see these things get built in a specific interest rate or macroeconomic environment, and then conditions change, and then suddenly some of the parts of the business don't make as much sense, right? So things I would look at would be things like, well, how will inflation and potential supply chain shocks, which we are seeing under the Trump administration, how might that impact the cash flows of long-term rentals if it becomes more expensive for a landlord to like manage a bunch of rental properties?
Or if you're flipping a property, who's going to buy it in a flip model when rates just look like they're staying high for a good while yet? So there are no buyers, and the only people buying are people who are like already had a place, or sort of retirees or whatever. There's a certain segment of the market where it's moving, but a lot of it's completely frozen. And so like the music could stop. So you kind of got to think like, is this was kind of my worry when I sort of saw it from a glance, which is this something that worked in a certain part of the cycle? Is this something that continues to work? Are they playing in a segment? It's kind of like a built rewards thing where there are more renters now, so maybe there's more demand to serve those renters with a certain type of financial product. And I think there's something novel there in the flipping and the lending against the rental income, and like treating landlords as people with a financial asset. How mature are they? I think it's the same, but it's different. It's like the cash advance thing was more purely retail focused, whereas this is at least a little bit more landlord and or somebody who's got a portfolio of properties prosumer focused, and maybe that's the underwriting model. But I have the same sort of instinctive reaction that you have is when anybody says we have all of these data points and this underwriting model and machine learning, part of me goes, usually when I hear this thing, pain follows.
I've been alive too long, Simon, to take the like underwriting model with thousands of variables thing seriously anymore. And it's not to say that it's bad. It's just it needs to be wedded with experience to know like which of those data points matter and which ones don't. And to be fair, the founding team here has a lot of experience, both on the data science side, but also on the mortgage lending side, right? And so, they know this market, and I'm sure they have some of that scar tissue. And I will also say, to your point about this being the same but different, it is different in the sense that, and I think we see this actually with buy now, pay later too. It's easier to sort of hold yourself accountable to the eccentricities of different markets or different opportunities that you're evaluating when you're doing it through partners rather than doing it directly, right? And so these guys are enabling platforms that serve that prosumer segment who might want to do some real estate investing, which means that it's not Vontive that is doing this work. It's the end person that they're serving who wants this loan. They're the ones doing the evaluation. They're the ones thinking about, ooh, this rental property would be great if I could just buy it, fix it up a little bit, like then the cash flows would come in. So in a sense, you're not centralizing the judgment on some of those things as much as like a Zillow was with iBuying. You're more sort of decentralizing it across all of your partners and across all of their end customers. And so I do think this is the same, but it is also different. And the difference might be enough to make it like a better business and something that makes more sense. So I do think like there is reason for optimism relative to maybe some of the flameouts we've seen in the space in the past.
Well, that was kind of the point I'm stabbing at here, which is like you almost want to put aside that default inner critic of like, oh, I've seen this before, because maybe they've got a wedge here. 90% of the time that gut instinct is there or thereabouts, but there's enough here to say, the jury is still out on this one. This could be a very interesting model, and I'm surprised I've not seen more of it. And maybe it's just one of those things that it's so niche that you wouldn't hear about it. But this thing seems like it's big, it's gaining traction, nobody's heard of it. Why? And you have validated a lot of thoughts for me there, so thank you.
Well, you're very welcome. And again, the company is Votive. I think I keep saying Vontive because my brain is broken, but Votive. I agree with you, though. I mean, I think that at the end of the day, there might just be enough differences or sort of evolutionary differences with this model, particularly how they get to those borrowers, that I could see this working better. I will also say, just as a final thought, the private credit markets keep surprising me in terms of their durability and their just sort of insatiable appetite, right? And so when you think about the trends here, that's the other trend that is just that this is clearly tying to and building off of. Clearly, it's not just private credit funds, right? Because now they have Citi with the securitization shelf that they've secured. And so I think they're doing a really good job of building diverse different sources of liquidity. So if one kind of takes a step back, another one can take a step forward. That's really critical when you're sort of a non-bank originator of mortgages. And so a lot to like here. And I think, as you said, they seem to have gotten to a scale where some of these proof points seem now to exist in a way that if we were looking at this 5 years ago, I probably would have been more nervous about. So one to keep studying.
Heck yeah! Let's do the Not Fintech Investment Advice 1 year review. Maybe this could be a fun new segment.
Actually, I will say, maybe we should do a special annual anniversary episode. That's actually a good idea. Let's file that one away. I like that idea. But Simon, before we get to that, a year from now, when we're telling people how bad or good our analysis was, why don't you do a little more analysis and give us your second company?
Oh, right. I'll give it a go. This one is called Atticus. And unlike most companies we cover on Not Fintech Investment Advice, I have almost no idea what they do. And that's why it's very much not Fintech Investment Advice. So Atticus ostensibly appeared to be a consumer neobank built on stablecoins. Some of the fintech investor community may have seen the pitch deck that was going around. And my understanding of that pitch deck is that they were looking to raise a seed that would value them at around $50 million post. And, a bit like a consumer neobank built on stables. There's a few of these that have popped up. There are B2B neobanks. Instead of using the FBO account structure, you use stablecoins as the way to store and move value for the consumer. And of course, then ultimately, the fiat is off-ramped into a bank somewhere or held against treasuries. Right, so that model made sense. But what changed is a story dropped late last week from Axios that is now reporting that Palmer Luckey of Anduril fame is personally leading a new round at a $2 billion valuation.
Wow.
So I saw this and I got curious, and I'm now entirely speculating at this point. And I have my own thoughts of what could this be? Why could this be? But what do you think about the broader space of neobanks on stables generally? And then kind of let's get to this specific, why these people?
No, that sounds good. So I will say first off the bat that you're right. This is extremely not fintech investment advice, extreme version, not fintech investment advice, because we don't know much about this company. But I will also say, I think it's fair game to do a little speculating. If you're going to operate in stealth and try to raise this type of money before even telling people what you're doing, we get to speculate a little bit. So I think that's totally fair. I mean, I think that broadly speaking, Simon, my take on your neobank kind of banking as a service point, I actually wrote about this in a piece where I sort of argued that stablecoins have the potential to be very bad for community banks. And one of the threads I was pulling on in that piece was this idea that The Durbin Amendment, which capped interchange fees but carved out an exemption for banks under $10 billion in assets, kind of created this like artificial right to win in the banking as a service space for community banks, right? That otherwise probably wouldn't have existed, or at least wouldn't have existed quite to the level that it turned out, right? Community banks dominate banking as a service today. And when I was digging into stablecoins and learning about how they're going to work, particularly in a post Genius Act world, which we will soon be living in, it just seemed to me like fundamentally a regulated payment stablecoin provides a lot of the same basic building blocks that a banking as a service bank does, right? Like you can store funds, you can facilitate payments. Unlike a lot of banking as a service where you're having to like integrate with a community bank's core or sort of like work directly with a community bank. Stablecoins, I think, are out of the box a little bit more easily programmable and easier to sort of build around from a developer perspective. And particularly when they get wrapped with additional capabilities by somebody like a Stripe or I suppose someone potentially like Atticus, and really has sort of a developer-oriented mindset for how to like present stablecoins to people who want to build stuff. The question I kept coming back to was, if you're a fintech founder, and I'm trying to put myself in the mind of a 22-year-old fintech founder who's sort of an engineer by training, doesn't really think in terms of like financial services, but thinks more in terms of like kind of founding, building, shipping code, building products. I just was sort of thinking like, why would I choose door A, banking as a service, when I could choose door B, which is stablecoin as the underlying infrastructure? And of course, there's lots of interesting kind of downstream implications, which we can talk about, of choosing door B versus choosing door A. But strictly from a fintech founder's perspective, I don't know why you wouldn't choose door B. That makes just as much sense, if not more, in a lot of ways, particularly if stablecoins are kind of the cool kid, infrastructure of choice these days, which I think it is.
Yeah, it's hard to say no to that. Do you become run the gauntlet of a bank's program management office and get your level of compliance to something where they feel comfortable with the risk of you,
Right.
or do you just go build on stable coins? Now there's APIs and they're treasury backed and there are many issuers of them. I think the hardest part with that is always like the backward compatibility with the rest of humans' lives, which is still in the existing financial system. And that's what made me think about something here, which is there's, I think Lead Bank are supporting a lot of what Stripe does, and they've been quite sort of forward in their support of the stablecoin industry.
They're the bank behind the Stripe card, right? The one they're doing in Latin America. They're the issuing partner, right? Yeah.
Correct. And they do a lot of that sort of stuff. Like generally they really lean in heavy to kind of innovation. And why is there a bank in the picture? Well, somehow you got to make this all connect to ACH and FedWire, and it's really helpful for them to have a Fed master account so that they can have the lowest cost of fund. Like there's a lot of de-risking
Visa,
that comes
MasterCard,
along.
right? Yeah.
Exactly. There's a lot of stuff where you can go get special charters as an acquirer, and you can but there isn't an OCC federally chartered bank that is like just for developers. That doesn't.
Yeah, right.
Maybe Column could get there, but they're not doing it today. Right. And so that thing doesn't exist for this segment of the market. So it made me think: is this moving towards like that sort of bank for stablecoins? Is that the goal here, or is this more of a USAA competitor, which is like, hang on a minute, we've got Anduril, we've got a lot of military contractors, we've got Doge now. Could we just make it a super low cost model for serving all of the federal employees of the United States by dropping their payroll directly into this thing on stable coins, which would drive up the demand for US treasuries overnight, which is a goal of the administration. I don't know if that's a little bit too clever by half, but or too hard to pull off. But that was one thought I had of like the USAA competitor. Is it a bank for stablecoins? And then the third thing I thought about is like the bank for businesses in defense that are global. Underwriting probably has to pay people at the last mile. They have to be able to move money around the world, and they'd want to move dollars around. Starlink is one of the biggest users of stablecoins already.
I was just going to say that. Yeah.
SpaceX potentially is. So you've got the folks with a very close set of ties to the administration, the new tech military industrial complex.
Mm-hmm.
A lot of that valuation could just be, we need this infrastructure to do these things that we can't do today within the banking system. And we'd really like perceived Operation Choke Point 3.0 not to happen. I smile because I don't like. There was definitely pressure put on to various institutions, and some of it may have even been political. Some of it may have been risk-based. But the Operation Choke Point...
You're not a big believer in the grand conspiracy version of it, Simon?
Yeah, there's a grand conspiracy version, for those not familiar, of Operation Choke Point 2.0, where it was attempting to cut everything out of the financial system that was crypto. I think the net product of crypto itself was that it nearly did that to itself, and some of the regulatory reaction to that nearly did that as well, because it wasn't always well handled. I would say it's like, never ascribe malice sort of situation. But to zoom all the way back to this, if you perceive it to be true that there could be a future administration with a future Operation Choke Point, but you've already got to federally chartered status and you already have an account with them, even if that thing ends up under a consent order, then it's still going to be around. You still built that thing. So those are my three models of just straight infrastructure with access all the way into the banking system. USAA, but by Doge, to cut out cost, or the bank for the defense industry that is unkillable. I don't know. I could be completely wrong, but
No. It's super interesting. I think all of that is very good speculation.
Simon and Alex make stuff up.
Right. It's conspiracy corner. Yeah, no, I mean, it's this is what happens when you're raising at multi-billion-dollar valuations for a company that you haven't described at all. Like, we're going to guess. We're going to paint our little visions of the future onto it. I mean, so a couple quick things. One, on the sort of deep infrastructure tying into the banking system point, that I'm really fascinated by, because it's actually not totally clear to me what the limitations of a stablecoin issuer versus a bank are going to be in a post-Genius world, right? So we know that with the Genius Act, which is, again, just for context, very, very likely to pass, to be reconciled with the House bill and to be signed into law, right? All the big barriers have sort of been overcome, and at this point, it seems sort of fait accompli that that's going to happen. Under that act, as I understand it, there is an ability for a stablecoin issuer that's not already regulated in some other fashion, like being a bank, to get a special form of a charter. I believe it would be issued by the OCC, that would allow them to issue stablecoins at a federal level. And that charter type is in some senses a new type of bank charter that's just very narrowly focused on stablecoin payments, right? And the thing I don't know the answer to, candidly, just being totally clear, maybe someone else does, or maybe this is kind of unknown and it'll be figured out once we start actually writing the regulations around the Genius Act once it passes. But the thing I don't know is, does that charter allow you to get direct access to the banking system, or do you still have to go through a bank to get it, right? Because right now, Stripe wants to launch a card that serves businesses that's focused on Latin America. Well, at the moment, Visa and MasterCard can't directly work with a stablecoin issuer to have them on the network. However, in a post-Genius world, would Visa and MasterCard be comfortable from a regulatory perspective, essentially allowing stablecoin issuers into their network as issuers directly the same way that they do banks? I don't know. Maybe, maybe not. Same thing applies to the master accounts at the Fed, right? Historically, if you do anything in crypto, the Fed says, nope, you can't touch master accounts. We're not going to allow you. That's been the subject of a great deal of controversy, going back to Operation Choke Point 2.0 and various conspiracy theories. But you could kind of see the Fed's point where they're going look, we don't even really know what these crypto things are. Stablecoins don't have a clear regulatory framework. We don't feel comfortable with this. In a post-Genius world, if you get an OCC charter to issue a stablecoin, I think that should allow you to harmonize across the various regulatory agencies to the point where the Fed is saying, okay, yeah, no, you can get direct access to our payment rails, you can get a Fed master account and all the sort of benefits attendant to that. So I think there is a world where you actually don't even need banks at all to store money, to facilitate payments, including getting access to, as you said, Simon, the sort of real world payment tools that all of us still use today, right? Like as a consumer, I still want to be able to ACH over to a different bank. I still want to be able to use a card and swipe it in the store. But if you don't need a bank to touch any of the intermediary parts and it can just go directly to a stablecoin issuer, that would be a game changer, A. And B, it would probably be something that would be worth putting a lot of money into if that's what Atticus is indeed aimed at. So that's one. All of the military industrial defense stuff, I think, is really like good speculation. Like, why is Palmer Luckey interested in this? There has to be a reason for that. I have noticed the same thing you've noticed, which is there does seem to be this overlap between like sort of, I guess you'd say, sort of the new right, the tech ecosystem, and sort of the defense ecosystem. Like there seems to be sort of a convergence between those three things. And this is like Starlink, this is Anduril. This is actually, I think, strangely also Ramp, not so much from a defense perspective, but like I think you've seen some of the reporting about this, right? Where the government might use Ramp to manage like corporate expenses, and Ramp has really been pushing, I think, to try to get access to that. So there is this sort of convergence of these three things. And if you were to ask anyone who's involved in that like overlap of areas, like, hey, what's the infrastructure from a financial perspective that we should be using to do this? It kind of goes back to my point earlier about like what's the sort of in vogue answer right now. Like stablecoins are the in vogue answer right now. Whether it's actually the best infrastructure to use for the use case or not, I think it's the popular choice right now. And so it wouldn't surprise me if, particularly with Palmer Luckey's sort of government connections, if he saw an opportunity there to tie sort of fintech, tech, and sort of defense or sort of government more broadly together, particularly kind of, Simon, to your point, a lot of stuff that touches government, a lot of stuff that touches defense, it does cross borders, right? And there is national security implications about the strength of the US dollar and demand for treasuries. So, stablecoins have the benefit, I guess, of tying a lot of different threads together into one thing. And that might be appealing to people who sort of sit at the convergence of those different areas.
We'll have to watch this one because we don't know. We just don't know. But I really buy your idea there that there's this access thing is just so differentiating if you can get it done. But also I see the Claros Partners folks talking a lot on LinkedIn lately, Michelle Alt, Conrad, and such like about like, the door is open to discuss getting a charter, possibly more so than it's been in a while at the OCC and other places. But the path to getting it and the door being open is still not a simple process to follow. And even if we do get this new narrow permitted payment stablecoin issuer, the PPSI sort of model coming in, that's going to be non-trivial. Like you're still hitting a very high regulatory bar. It's not like you're going to get these things rubber stamped, is I guess what I'm saying. Like far from it. And if you become a permitted payment stablecoin issuer, then you're a stable. You can issue stablecoins, but as you say, there's no guarantee that it accesses the rails and the infrastructure. So you might need a full banking charter for that, and there's no guarantee as well that you could be a provider of credit. But what I think, to your worry about like narrow banking and sort of that push towards the thing that would threaten the community banking model, we sort of have a lot of the pieces for this already. Consumers are buying money market funds faster than ever before. Private credit is dominating lending and a major threat to financial institutions. And it was actually Dodd-Frank, creator of the Durbin Amendment, that meant that the banks that are large enough would struggle to lend within and maintain capital adequacy ratios. So you see that the rates they paid came way down on deposits because they had to find that spread from somewhere else. They ended up creating their own competition, did some of the small banks, by serving them, and now you've got this consumer distribution play. Only the big banks were able to really make the economics work. So you've got this squeeze that was already happening, and onto this come stablecoins. And so if you think you've got this distribution, this new sort of app, this new type of way of storing money, private credit funds are going to be looking at that and going, this is amazing. Another place for us to go deploy all that capital.
That is exactly right. Yeah, I mean, there's only so many more life insurance companies out there that private credit firms can get access to get funding. So they have to go somewhere to fuel this sort of machine that's been built. And yeah, I'm glad you mentioned Dodd-Frank, just to wrap up on this one, because that was actually the framing that was used to describe the Genius Act at StableCon on the panel that I was on. Was the Genius Act is essentially kind of crypto and stablecoins Dodd-Frank moment, right? Which is to say, we don't actually get big pieces of legislation that reshape financial services regulation very often. And we almost never get it when it's not coming on the heels of a acute financial crisis, right? And so I do think, much in the same way that Dodd-Frank had a bunch of like long-term implications on private credit and bank lending and deposit rates and banking as a service and how innovation in our space is enabled. I think the Genius Act will have a bunch of those same ripple effects, and it's kind of hard to predict what those were, or what they will be. Maybe, a $2 billion valuation is the way to go. Who knows?
Let's see. We got one more company to do, my friend. Not Fintech Investment Advice. Me, is this one a little bit more in our sweet spot?
Yes. Well, so this one is going to take us in a little bit more, as you like to joke sometimes, of an Alex direction, but hang with me here. So this is Affiniti, AFFINITI. They do embedded vertical specific small business credit cards. So raised an $11 million seed round last year, just raised a $17 million Series A. And what they do that makes them kind of interesting and unique is they partner with professional associations. So the Professional Association for Pharmacies in the US, or HVAC installers, or auto dealers, et cetera. And the association co-brands the card, which gives Affiniti sort of instant credibility and a pre-qualified member list to then start reaching out to and selling the card to, right? It underwrites the card based on the unique attributes of the different industries that they serve. And increasingly, they are integrating with business banking, bill pay, ERP, point of sale systems, which give them expanded visibility into businesses' cash flow patterns, which further sort of reinforces its ability to underwrite on a sort of industry by industry basis. In addition to that, it offers a very lightweight kind of dashboard that does transaction reconciliation, receipt capture, syncs with QuickBooks and Xero, exports general ledger entries, kind of like poor man's like ramp Brex functionality, right? Very basic. And then it apparently, and this is what some of the funding is being used for, is introducing sort of an AI-powered CFO agent that will analyze cash flow data, flag anomalies, forecast vendor bills, and even suggest like when to raise prices or renegotiate terms with suppliers, right? So it's pretty interesting. It's kind of, I guess you could say, like a vertical specific version of like a ramp, much lighter on the software functionality, although gaining steam there with, especially with the AI capabilities. But critically, is distributed through these professional associations. And from what I could gather, like they are trying to reach into parts of the SMB market that Ramp and Brex are just never going to get to, right? Because Ramp and Brex tend to be much more high growth, startups, kind of more tech oriented. They're moving more into sort of the enterprise segment. And what the Affiniti co-founders were saying when I was looking at some of the interviews that they've done is that like they're working with businesses that have never touched fintech before, right? Or in some cases have never even had like a business credit card before, right? And so even though like the dashboard and some of the functionality they offer might not quite stand up to like a Ramp or a Brex, just, apples to apples, the reality is by going through the associations, they're getting to these Main Street style businesses that have just never seen anything like this. And it sounds like it's quite differentiated. So interesting. I've actually seen, Simon, quite a bit of fintech companies trying to sort of kind of follow on with this like vertical SaaS trend and this like trend towards vertical specialization. But the thing that I've seen as a challenge is how do you make sure your product is differentiated, and how do you make sure that your customer acquisition is efficient when you're trying to reach in and sell to all these different verticals, and them partnering with like the air conditioning contractors of America, just as one example. That seems like a like one of those things that in classic not fintech investment advice, like we like show me the hard thing you're doing that other people aren't willing to do and the advantage that creates. That seems like a really hard, annoying thing that these guys have sort of figured out and have taken on the work of doing that will create some differentiation.
It's ramp as a service with differentiated distribution. It's really, really nice. And the problem with trade associations is it's very hard to find ways to add value to your membership. This is a way in which, and they tend to run it, like at cost. They tend to always, they never have enough people. It's not an easy business to be in. Like it's really, really kind of giving them a big, big win for their membership. They're always trying to add that member value. Here it is. Here's a bunch of value that serves your problem space, and maybe they benefit from that in some way, shape, or form. Did they speak about that business model at all, or how the trade associations benefit?
Yeah, my sense is, so from a trade association perspective, I think the main benefit, as you said, is just making like themselves stickier, right? Like, be a member of our trade association. Oh, you should absolutely renew your membership dues because one of the benefits you get is this card. So I think from the trade association's perspective or the industry association's perspective, it's more about stickiness and keeping members engaged and doing so in a way that doesn't like require them to expend a lot of resources themselves. From Affinity's perspective, my understanding is it's mostly an interchange and lending business right now, right? And so it's credit card interchange plus whatever sort of interest they're getting on the balances on these cards. Obviously, that does expose them to credit risk, which, as we've been talking about in this episode, is a challenge and something that you want to sort of manage. So I think one question I have is, how does the underwriting continue to strengthen and get better? How do you lean on those associations to help you understand sort of the nuances of the businesses that they serve and why they're different and how you can underwrite them? So I think that experience is important. And then the other thing with any area that serves different verticals that I always wonder about is, how much do you focus on going deeper from a functionality perspective, which is to say, do they want to add more stuff beyond the card and the dashboard and the AI agents? Do they want to do other types of lending? Do they want to do business banking directly? Like, how do they want to build out their product? And then sort of contrast that with, how do they want to expand horizontally, right? And so do you want to continue to go into more industries? How many industries can you serve while still being differentiated in the way that you do that? And so I do think there is kind of an art to figuring out breadth versus depth and kind of navigating that. But again, conceptually, the model of like, as you said, sort of embedded ramp as a service through these industry associations, I hadn't seen this one before, so I thought it was interesting.
No, I'm with you. I wonder what distribution wedges are out there for this type of spend management platform to go find next. It's got me curious, Alex. You have tickled my curiosity. Thank you for doing that.
Well, it's what I try to do, Simon. Before I let you go, can we manifest a couple quick things?
You please be my guest.
All right, I've got one because this came up on a podcast that I just released. I did a interview with Alex DeMarco, who's the founder and CEO of MoneyStack, which is a sort of behavioral science platform and financial counseling platform that works with consumers and groups that have potential financial challenges. They started with gambling, so they work with a lot of the states that have like these kind of problem gambling resource centers and resources set up. They basically do a lot of the sort of financial counseling and financial help associated with that. So we were talking about gambling, which is a subject I'm just obsessed with these days. And Alex asked for a thing in that interview that I'm just going to pass along as something I would like to manifest, which is, could someone please build a predictive model trained on cash flow data that can detect early signs of problematic gambling? And the thing about this that's interesting is I actually think this would be pretty easy to build. Like, just from a data science perspective, if you have access to cash flow data, I think it'd be pretty easy to look and find, especially if you partner with someone like MoneyStack, to be able to look and find what are the early signals that suggest someone might be struggling with gambling. And the reason that's important is if we can identify those signals early, we can then offer to connect those customers with different forms of treatment, intervention, support, help. And the earlier you do that, the more you can sort of head off problems at the pass and not get them to the point where, I mean, unfortunately, gambling addiction has the highest rate of suicide of any form of addiction, which is horrible, right? So, like, you don't want people getting to the end of that road. You want to get them off of it as quickly as possible. So, can we use bank account data? Can we use transaction data to try to detect early signs of this? I will say, I think one of the reasons maybe this hasn't been built yet is that a lot of the companies that are in like the pay by bank space or who've been doing kind of early stuff around cash flow data, a lot of them work with the gambling companies, unfortunately, like they're customers of theirs. And so there is a bit of a problem there. But I think as open banking and transaction data and cash flow analytics become wider spread, and as banks start getting into it more, I think that we can actually potentially maybe get a bank interested in building a model that could detect this, because quite frankly, it's in banks' best interest, selfishly, to try to stop their customers from slipping into a gambling problem, because then that's just money taken out of savings or investment or other things and put towards a non-productive use. Right. It's not in the P&L for them. It's not good for the customer.
So in 2018, Monzo did a hackathon where they built the gambling block functionality. And the idea was I could set myself on a cooldown for 48 hours and then have to phone a friend in order to get that unblocked again. And I think it's these sorts of things, these innovations in features that are customer-centric that just need to make a comeback. Like, the bank branch was the heart of the community. Like, the bank feature is the heart of the digital community. So let's get there. Now, I was gonna manifest something, but we're fresh out of time. So I think that's just the perfect place to leave it, Mr. Johnson. Thank you for having me once, as always.
I appreciate you, Mr. Taylor. We'll have you back next month.
Take care, sir.